Just don't provoke me, cause I don't need no cellmates. I'm in a two-seat, doing drops like a mailman. This ain't no hoopty, yeah, she riding, she's a hell yeah. No, I won't lose sleep about no pussy, I'm like farewell. Yeah. I'm outside. I know how it feel to see your homie switch sides. I know how to put that Rolls Royce shit in drive. I know how to load a clip and shoot, we gotta ride. You ain't gotta lie to me, baby, no. You know it's a vibe every time we catch him off sides, he won't make it, no. Money on my mind, I can't get it all.
All right, we're back at it again here at True Pod Studios with yours truly, Mr. Jonathan Hernandez and Kenny Jorge, and podcast engineering. It's your boy, Alex Doomsday Linez. We're here to talk about mortgages and personal loans. What is a mortgage? How do I get a mortgage? Your mic is definitely up now, champ.
What's going on, guys?
A mortgage, man. Yes. What's that called? The American Dream, right?
I think that's what it's called. The piece of the American pie.
Oh, yeah.
You know what I mean? It's owning a home.
Yeah, they
right?
get into your pie, all right. Like, they get into your pockets, brother. They're crazy.
They're getting into the pockets, but we're here to tell you guys how you can actually obtain a mortgage. What are the requirements? Some of the requirements, right, John?
Yeah. We're going to talk about mortgages, how to, just a couple different products, I would like to say.
Okay.
In order to get the mortgage, down payment, minimums. And what are some, like, PMI, private mortgage insurance, what that is.
Okay, so just before we get started, tell us a little bit about, I guess, your experience in that market, which is real estate, right, John?
Yeah.
And Kenny, I'm aware that you also were in the real estate market
Yeah,
for a little bit.
my actual background is real estate. I do taxes, truthful taxes. We were part of that family, but my actual background and what I consider my expertise is real estate.
Yes,
But Kenny, in your experience, you said 10 years you were in the
Over
game?
10 years.
Over 10 years.
I started. My first property was 20 years ago.
20 years. When you say your first property that you purchased?
First time going through a mortgage process.
How old were you?
19.
Oh, so you were a young buyer.
Yeah, that nigga Legos.
Wow.
Yeah, I was buying Legos and
buying houses at 19.
While people were playing with Legos, I was playing with
real houses.
Real houses. I started playing Monopoly at a young age.
All right, so we're gonna pick at your brain. Obviously, you've been in the market for over 10 years. John, you've had much experience in this field. Probably not as much in time frame, but your tax business sometimes goes along very well with and coincides with mortgages.
It's the only way you get a mortgage unless you got a serious amount of cash that you're gonna be purchasing, straight outright, or you might get a hard money loan, which is like death loans. But at some point in time, you're going to need to go conventional out of that loan, or you're going to need to buy it in cash. And good luck. Yeah, not a lot of people.
I don't think everybody's walking around with $500,000.
Nah, that's not happening. That's not happening.
So no, nobody's buying. I mean, unless you're somebody that's super wealthy. But give us an intro into this topic. What are the steps? Like, I'm not a homeowner. I've been renting all my life.
Well, there's 3 steps. Very simple.
Okay.
Credit, down payment, taxes. That's it.
Okay. So your credit score has to be up to par.
100%.
And
so look you can get a house at 620 credit score, but you might not like your interest rate. Right now the interest rate is terrible, right? Like off the chart terrible. All right, they're like 6s, right?
As of today, what is it? When we're filming right now, it's in the 6s.
6s.
We expect,
but if you have a shitty credit score, you might be an 8.
Yeah, that's 6 with A1. We're talking about 760. That's A1, and we're in the 6s. We're expecting. I follow the market. Mm-hmm. End of the year, we're 7s for A1 credit.
So for an A1 credit, you're looking at about 4 to 7%. You said
right now it's in the 6s.
6% interest rate on whatever loan you're taking.
All right, so let me show you what that interest rate does. You ready?
Okay.
One of my homes that I own, my first home, it's at 3% interest rate. The payment is $4,126 a month. Today, it is 6.125. That is literally double the interest rate. You know what that means? Double the payment.
And you have you have no control, or is there? I know I've heard of fixed rates.
So no. So fixed rate versus is called an ARM, right? An ARM is called adjustable rate mortgage.
All right, so I'm gonna tell you something about that ARM.
Okay. Woo! Now actually, let me say it and then let me give him his experience. You ready? So check this out. I have a fixed rate. So whether the economy tanks, goes up, left, right, it stays at 3. Mm-hmm. But an ARM is an adjustable rate mortgage where it adjusts as the economy does bad, it's going to go higher. As it does good, it'll go lower, but it can only go up to what you entered at. You get what I'm saying?
As high as what you entered at.
Yeah. So if you
as low as
oh,
low.
so it's as low.
As low.
low.
But it can go up based on the economy. So as the economy does bad, they raise the interest your arm so you can pay more for your mortgage so they can make up on the losses.
Yeah.
Wow.
So I'll tell you a quick story. So my intro was I got into real estate super young, 19 years old, and I knew too much for my own good. Meaning, I knew the importance of having properties and investing my money into real estate. Mm-hmm. I just did not know enough, right?
Okay. And what did you encounter?
I encountered that when I sat down for signing for my mortgage and the sale of the property. I know 19 years old. I thought I knew it all, right?
Yeah. Don't we all?
Yes. I thought I knew it all. So when they tell me, I knew enough to know that interest rates is going to determine my actual mortgage payment.
Yeah.
What I did not know was how an ARM, an adjustable rate, will affect me.
Okay.
So
at that time, you weren't privy to the ARM.
I was not privy to the ARM, and that ARM,
The arm went all the way in.
So I'll tell you how. So I'm in there. I'm 19 years old. I close.
Damn, you was tight. 19.
I was 19 years old. I'm great. The actual interest rate was low. Like was pretty low compared to because it was an ARM, right? It sounded real good.
Sounded good. So you got it at a low
interest at the time. We're looking at 2004.
2004. And that's 18 years ago.
That's 18 years ago. That's pre-crash. So I'm living life. I'm down in Miami. I'm living life. I'm paying my regular mortgage. Year 2, I'm paying my regular mortgage.
Oh.
Year 3, I'm paying my regular mortgage.
Okay.
What I should have done, and I just did not know, was it was okay to get into the ARM, to the adjustable. If I would refi into a fixed rate, I would have been clear.
You would have been clear.
I would have been great.
You'd have been clear of what, though?
Clear of
not being in the ARM anyway. Yeah,
exactly.
Yeah.
I just didn't know any different. And that's where being young and you know, just did
a little careless, maybe?
A little careless, being young, not being around, you know, not self-educating even further.
Yeah.
Year 4, now we're looking at 2007, that's when the market starts crashing. Mind you, by year 2, I already had over 100,000 in equity.
On one property?
On one property, because it was just going up.
Mm-hmm.
I'm fine, cool. Year 3, 4, market crash, my mortgage tripled.
Damn.
Tripled. I was paying over $3,000. I'm not mistaken. I think it was like $3,500, $3,600 for my condo. No! The ARM grew.
Wow.
The ARM got me.
How do you even? God, I couldn't imagine if all of a sudden my homeowner comes and tells me your rent's 3 times the amount now.
Well, yeah. Think about 4,126 times 3. That's 12,000. That house is getting foreclosed on.
Yeah. Holy cow. That 100,000, 120, 130,000 equity was dropping weekly.
100%.
By 10,000, 15,000, 20,000.
Yeah.
And we'll get into another conversation because that led to short sales and eventually foreclosure and things of that nature.
Okay, we'll keep it on the other episodes.
Yeah, that's another episode I'll go into. So, and that was my introduction to real estate, and I've never left real estate for whatever reason. I love it. Mm-hmm. That's my background. That's what I consider my expertise. But it started from a personal personal experience, right? I still think it's one of the best investments ever, owning a home. I know that there's different methods. People don't believe in it, especially multi-millionaires and billionaires. They're kind of against owning homes for whatever reason.
Yeah, I've heard that they're not.
But I still think it's a safe, especially now. After that crash of 2007, 2008, there is things in place, especially in the mortgage industry, to avoid that happening. Yeah. One of those is PMI, and John can touch on that.
But private mortgage insurance. But I think the main document that caused all of this for the mortgage crisis, and this is where people don't even know where to begin to talk, and this is where extreme tax professional will tell you, I know what the fuck caused the mortgage crisis back in 2008. People approving people approving loans. Well, banks approving loans with people who didn't even make that motherfucking money.
So they were just giving out money.
100%. So look. The document that caused this problem was the bank not requesting 4506Ts. What a 4506T is, internet world, YouTube, it's called a transcript. If you make what you say you make, and you file that at the end of the year, the transcript will show that on the IRS's side. So if I say I make $1 million, the transcript should show $1 million. The problem was people were saying that they make $1 million,
they don't make it,
and they get a tax return that was never filed. They give it to the bank takes it for face value. The bank says, wow, you have the down payment of $100,000, you make $1 million on your tax documents. Wow. You're approved for a mortgage of $7,450. You got that mansion that you wanted. Meanwhile, he only made $50,000.
Oh my God.
But can they afford $7,000? Possibly. It's probably a barber who doesn't report or his income. You never know. But when it came down to shit getting real now, because the arm went up, they couldn't afford $15,000, $20,000 a month on a payment. Then what happens? You get the boom, the crash. When you get the crash, they start investigating. Wait, time out. Where's the transcript? We don't know what that is. Time out. That guy never even made over $30,000. How the hell he got approved for $1.1 million mortgage?
So at the time, I was seeing individuals purchasing homes, making $35,000 a year in their regular 9-to-5 job,
$500,000 loans,
and owning 2-3 properties. Right, and once again, I was always aware, and I knew enough. I knew enough that something was wrong. There's no way. I had 19, 20 years old. Yes, I was ahead of my time, and a lot of stuff fell through the cracks. But I knew enough at that time that so and so making $12 an hour should not be purchasing her third condo. It's just something is not right. Red flags. But like I said, the industry corrected itself. There was a lot of mortgage fraud and things of that nature. Right now, even with possible recession, I think that the real estate industry has put policies in place to prevent a crash. You might get a flat line, but just to, a property value at $700,000 to drop to like $300,000, how it was. I personally do not see that happening.
We don't have a mortgage problem right now, a mortgage crisis like before.
No.
We don't have that. Okay. All right? What happened is we have like price gouging.
Yeah.
All right?
What do you mean?
People can afford the home right now. Before, people couldn't afford the home. So it crashed dramatically. People who get qualified for homes now can afford them.
Yeah.
Doesn't mean they're not going to lose their job. You know what I'm saying? But right now, we don't have a mortgage crisis. We have a mortgage inflation on cost crisis, where everything is just astronomically high. That wasn't before. We lost the value of the homes. You understand? Now we're not losing value. It's too much value in the damn home. So getting a home is much harder, especially with the interest rate. It's damn nearly impossible. You can't outbid it $100,000 on a home. So what are you gonna do? You're gonna be forced to rent now. So the market, there's not that much out there.
It's not, and the
that's the current market.
The current market. Well, yeah. I say a couple of months ago, the current market with the interest rate going high, it's gonna slow down. Some say it's not, but I just think it has to. There's for those that are purchasing, at a 7%, it's tough. It's
That's
gonna make
tough.
it tough. Now the like I said, because of the crash, there's things in place so where it avoids people purchasing where they cannot afford the home.
Yeah.
That's why people were jumping off like parachutes. Like
I think the maximum DTI is 41%. Don't quote me, but I think it's about 41% of your total income has to be with including the mortgage. So let's say you have a car, 4 credit cards, a motorcycle, and you want to get a mortgage also. The mortgage payment plus your current DTI cannot exceed more than 41%. Some banks go higher, some banks go low, but it depends on the actual mortgage program you're doing. So if you're going conventional with a 680 credit score, they might say, yo, the DTI can't be more than 38%.
And for those that are listening, John, DTI.
Debt to income. So how much debt you have versus how much income you have available. So if I make $100,000 after taxes, I make, let's say, $50,000. I'm just giving a raw number.
Yeah, yeah.
And I have $30,000 in revolving credit every single month. That means I only have $20,000 available in my DTI, my debt to my income. That's what that is. So the more you have available, the less DTI you are. So let's say in this case, I only have $1,000 a month in bills, but I make $100 million a year. You have
That scale's tipped in your way, obviously, right?
Yeah, 100%. It's in your favor. You have a lower DTI. Higher DTI, you're not really going to get approved for much. Or if you do get approved, you're going to need a higher down payment, or you're going to be paying more on the interest rate.
So let me ask you,
because you're a risk. You
I
understand?
get it.
The
The more
risk.
debt you have, the more
Hell
riskier
yeah.
you are
Correct.
to the banks, right?
Correct. So one of the tips that, and this is just on the credit side, and I'm sure people, YouTube world,
Listeners.
there's always a trick of, maintain your credit usage, your credit card to a minimal under 15%, right?
Yeah.
10%, I think it's.
No,
what they
actually,
recommend?
the key number, and everybody got different numbers, but
Yeah.
bro, it's 15%.
It's
15%.
After
yeah.
15%, like it literally goes down big time. So whatever move you're gonna do, if it's gonna be a credit pull move where you're pulling your credit, try to keep your credit card balance under 15%. This does not mean you have $1,000, right? You make an $850 payment to bring it under 15 and think that the next day it's going to be under 15. No, you got to wait 30 days till the credit report reports when was the last time it reported so it can reflect the 15. You know how many times I work with somebody, they go, yo, but I just paid my credit cards off. When? Yesterday. Oh, so you think that TransUnion say, yo, what's up? I'm gonna fix it right now. No, bro.
So yeah, my clients that I deal with, I would tell them, you have a credit card, you have $1,000 credit card limit, you have $150. Just keep that in mind.
Wow.
Yeah.
For all the listeners out there,
Just keep that in mind. It's like,
very
especially,
important. It's very important, and I don't think
it's a bad habit. It's a habit that we all have, and I think is part of financial literacy and just learning. It's a habit that we had from a young age, that when we first get that $200 card, we had 200. When that card was increased to 1,000, we have 1,000. No, you have $150. If you had $200 credit card, you have $25. Keep that in mind, because you will tank your credit score faster with maxing out your credit card than most things that go on your credit.
So how about what you guys got to say for the person who has more than one credit card and maybe has 4 credit cards, the total amount of maybe 40,000 in credit score
In credit cards.
In credit cards. So does that 15%
Use
apply?
one fucking card. Because let me show you how this goes, buddy. You can have 100 credit cards, and they all have $1 on it. But if you have one particular credit card that has over 15% usage on it, that shit is still dropping your credit score.
So is it 15% on your overall credit usage? Like,
yeah.
Okay. So
Yeah.
it's not like, oh, it's
not
only
just
15
one credit card.
Oh, okay.
Yeah. So just use one card, bro. Can you have multiple cards for benefits? Yes. Like one may be cash back, the next may be rewards. Mm-hmm. Great. But you do not need 15 credit cards. You just need 2 of them. That's it. With a good line on it, a good credit line, and you're good. 10,000 on one credit card is the same thing as 2,000 on 5. The fuck you need 5 credit cards for?
That could be actually problematic to somebody who has problem spending, right?
It is more control, more maintenance, but I could scale. I started maybe with 6 credit cards until I realized that 2 of them I've increased their limit so high that I actually don't need the other 3.
Also, yeah.
But I never cancel. Because credit card history is important as well. So if you have your card that you first started that, when you were 18 years old and they gave you $200 and 10 years later you're still maybe at $350 because they really don't ever cancel that card, because that card will allow you show up as credit card history.
Okay.
Right? And
Yeah,
that's
history
important.
has a big, strong effect on your actual credit score. So you could be a 720, and this is the good thing is that this actually doesn't affect the mortgage, the actual history. Your score is your score.
Mm-hmm.
That's it. But when it comes to getting a car, it's harder to get a car than what it is to get a house, because you can have a 720 credit score and go to BMW and still get denied, because you only got 3 months of history, of credit history.
Is that revolving credit?
Yeah, that's revolving
That's what
credit.
it's called?
So and I know this topic was more on mortgages and personal loans, but just to touch on purchasing a car, in credit history, you have to diversify. So your house credit is different from your car credit.
Yeah, there's different credit scores.
It's different.
There's your regular FICO score, then there's FICO 8.
Correct.
Mortgage companies use FICO 8. They don't give a flying fuck what your regular credit score is. Just like the car companies, they don't pull your regular credit score. They pull your FICO 8, okay? You can have a 720 credit score and have a 590 car score.
And that's for the lack of revolving credit.
Lack of history.
Yeah, you
Lack
can
of
have
history.
great credit card history, but no car history. That's a whole separate credit score. You can handle 2,000, but can you handle 34,000 on a car?
So with what I've done,
different things.
what I've done, and I know he's done as well, and this usually people do this without actually thinking about this. It's just life. You gradually evolve, and your income evolves, and your car choices evolve. But if you're actually doing it consciously, like I do it consciously, like I started with my first car. I started with a $20,000 Honda Accord 20 years ago, paid that off, right? And I've made my way to a $30,000 car, a $40,000 car, 50.
Yeah.
Now, like same thing with him. He started with the same thing. He had a car, a Nissan 350. He put 25-inch rims on them, and he had one of those, and gradually worked his way to a Mercedes, to a BMW M5, to now Lamborghini. It was no way possible with the same income that he was going to get approved for a Lamborghini if he never owned that Mercedes at $50,000, that $100,000.
No, if I didn't get the M5, which shows that I can support $2,000 plus a month, why would Lamborghini give you a $3,000 to $5,000 a month car if you only have a car history of supporting $500 a month? This is 10 times more.
Wow, yeah, you're absolutely
They're
right.
gonna go, are you crazy for even walking in here? You could give us $200,000 down, and we're not approving you. You can make $2 million a year, and we're not approving you with $200,000 down. They will rather see that you make $1 million, but have history of paying $3,000-$4,000. I have history of paying like $5,000 a month, $6,000 a month in cars. So when I got my first Lambo, they were like, all right. The dude bought 30 cars already in his lifetime. The dude currently pays $6,000 a month between his G-Wagon and his M5. So he's taking off, ready? He's taking off $2,200 a month and adding $3,000 a month. Only an $800 difference. But he makes XYZ. Easy deal. Approve. Bang.
So,
done.
like I said, people do this because of life. Life just, you gradually just evolve. He's done it. When I went into my Range Rover, I did that.
Shout out to True Rentals.
Yes, but this is my personal. So my personal Range Rover, I only got into that just to increase my car purchase history,
Yeah.
to close the gap from my X5 to, close the gap to eventually get into a $200,000 car. That's the only reason. I did not need to trade. But to me is the mindset of, if I ever want to close a gap between a $300 payment, $400 payment to a $2,000 payment, I first need to get to a $1,000 payment.
So the proof is in the pudding with these banks. That's basically it, right?
100%. 100%. These are loan officers, loan processors, and analysts that are literally analyzing your loan. They do one thing first. Before it hits a loan analyzer, a loan officer, or underwriter, it's going to go through an automatic system. If the automatic system approves them, so when you send at the dealer and they submit, it's an automatic system that's going to reply real fast back, saying approved or not approved. 98% of the time when it's not approved, the person who submitted your application is going to call the bank if they're not lazy, if they want to fight on your end and go, why is he not approved? Then there's going to be called stipulations. At the bottom, it's going to be a comment. It's going to say 620 credit score, need cosigner.
Oh, okay.
Or 620 credit score, must verify income and put down 10,000. Or 510 credit score, need cosigner, need 10,000, need proof of documents. There's stipulations.
Okay.
You understand? Some stipulations are very hard, and sometimes they put stipulations there to cripple you,
to just kind of like tank you, so you can just walk away.
Well, 100%. So actually, this happened to me. How long ago was it?
Like
3 weeks ago.
3 weeks ago.
So I have collectively close to $1 million, right, in cars, right now on my credit report, and my payments are probably $12,000 a month, right, in cars or more. And I was trading in one car. I was trading in what the fuck I was trading? A BMW i8, which my payment's $1,874 to pick up a car that was $2,300, $500 a month difference. You know what I'm saying?
Yeah.
So I'm like, okay, this should be a no-brainer. Nah. And my DTI 0. I don't carry no bills from 1 month to the next. Don't carry nothing. They come back and they talking about we want $71,000 down. I said, they don't want this deal. No way. No way. That was just the bank. So remember, you also have to understand how analysts think. It's not a person. It's not a computer. It's a person. People have bias. What happens if the loan officer that received my deal just doesn't like Spanish people? I'm just being real. And doesn't like the fact that I make XYZ and I drive a bunch of Lamborghinis and all this. What happens? He could press deny and that's it. Or he can make it impossible or make it uncomfortable for me to go get that deal.
Okay.
That's a possibility.
That's a possibility.
Listen, that's how I felt it happened. I'm like, yo, bro, I just bought 3 Lambos for you in 9 months. And this piece of shit car, which is $160,000, you asking for $71,000 down? I was like, yo, fuck you. You know what I did? I went and bought a fucking $170,000 car BMW with only $5,000 down.
Yeah.
Oh, wow.
So part of that too is the same way the same way they try to avoid the risk from you personally. Mm-hmm. That's what they're trying to do. It was a car that it's possibly going to tank. Right, because the car market. So they wanted him.
They wanted all the risk up front.
He wanted all the risk up front. They wanted him to pay all the risk.
They wanted to pay all the negative equity. They wanted to pay the commission to do it, everything up front.
Up front. That's
how it goes. So if you do wrong on it, oh well, they're gonna get the car back, sell it for $130. You know.
So that's basically where it comes down to. The reason why we talk about this is because, and even we deal with cars. I'm a real estate guy. We talked about it in the crypto conversation. We have to study. So I study the market. We study the car market as well. And that's another conversation we'll get into another day. Yeah. Because car market is experiencing something they've never experienced before.
And it's sort of tied in. Obviously, our topic is mortgages.
Exactly.
But it's also loans, right? So I see how you guys threw it in there. And I mean, whoever is listening right now, there's a ton of gems being thrown out here. I mean, I'm learning right here. I'm in school.
Yeah, he's looking at it like that.
So part of that, and just to talk about like the steps, right? That deal with the Range Rover, no stipulations.
Yeah, it was proof straight out the box.
Straight, no stip. I have no show of income, nothing.
Yeah. The computer already proved it, meaning their internal computer system already proved. So they didn't even need to call in
an analyst.
No, it was approved. They already got the buyer's order, bang, done. He gets the car, that's it.
Guess what? DTI was probably, I think, 2%.
Yeah, 2%. So it's saying basically out of all his available income, he's only in 2% debt.
Wow. That's great.
So when he adds the new car in, it probably brought it up to 24%. but that's still very low. The risk is low, so the meter is green. Like, dee-dee-dee-dee-dee. He's good. He's a good guy.
So just always keep that in mind. Another thing with guys,
That's how you actually supposed to, when you go get a mortgage, when you go get a car, make sure your DTI is next to nothing, because you want the tightest credit score on pre-qualification and at your rate lock. So what rate lock is 3 days before you close or about a week before you close, they need to lock in your interest rate. You want to make sure that all your revolving credit is paid down to zero. Not your car, but your credit cards paid down to zero, so that your credit score could be in the 700s, so that you could get the best interest rate lock. They lock it at 3%. But if during the pre-qualification and rate lock, let's say you fucking tank to 620, your new interest rate instead of 3% now maybe 5%. You can't do nothing.
So this is
because you can't speed up time.
No,
it's 30 days.
No,
right?
and you're about to close in a week. You're gonna lose your home. You're fucked.
You know what's crazy about this? About that time period in real estate and dealing with actual clients. For whatever reason, it's common for a buyer or to go purchase a car.
Always. They always do something dumb because they want a new car, a new house. What they do is they get the car right before getting a house. By the way, guys, DTI, once again, if you get a car, right? And your DTI, before you get a car, if your house included, remember I said it has to be a total of 41%. If your house is literally at 39% DTI, you need 41 tops. It means you only got 2% left to play with. Then your dumbass gets a car right before closing, and your DTI went up to 47%. You killed your whole deal, because now you got to put down a difference of 6% of DTI in order to bring it lower. That's cash up front. You totally fucked up. Get your car. Listen to me, everybody. Get your car after you get your home, not before you get your home. It directly affects the purchase power that you have for your home. So, if a $2,600 mortgage is $350,000 or $400,000, if you take off $600 off that mortgage, you probably lost $70,000 on a home extra you could have purchased. You got that?
No!
It's insane. It's insane. How often it's like a joke of, hey, you got your approval, congratulations. Now let's start the mortgage process. Is the 30 days. Please do not go out and purchase a car.
They bought a Dodge Charger that has 800 horsepower, and I'm like, yeah, just got my car, I'm about to get my house.
10 days
Then,
before.
What happened to the house? Nah, I fell through. It wasn't a good deal. No, you bought a fucking Dodge Charger.
Wow.
Underwriter's like,
Because it said Hellcat.
underwriter comes back and is like,
What happened?
what happened to his
deal?
His credit score dropped slightly because he just purchased. His
How
DTI
about
just
this?
went up.
You know how many people miss a payment during the mortgage process, and that rate lock, their credit is destroyed.
Wow.
The underwriters are going to be like, he just missed 4 credit card payments. He's not getting this loan.
Listeners, gems are dropping right now. Make sure you're writing notes.
During the mortgage buying process, you need to
Not breathe.
not breathe.
Just stay home. Relax.
Stay home. Talk to the
Hey,
wall.
look.
The wall is your
Binge,
best
binge
friend.
on a series. Don't
That's
stress.
it.
Yeah.
Because the underwriters are being paid to cancel your deal. You know why? They're being paid to protect the mortgage company, the bank. So Chase is going to pay me top dollar to make sure that you qualify for this loan. And they don't mind pressing no. You know why? Because they're going to lose more if they press yes on you.
Okay.
Got it?
Got it.
It's risk. Banks are risk. That's it. They lend out money to make
You
more
ever
money.
you ever heard the phrase saying yes is expensive?
It is. Yeah.
Yeah, I've heard
So
Yeah, fuck.
Oh.
It's fucking very expensive.
so yeah,
Shit.
saying yes is expensive.
So mortgage, yeah, man. Actually, my first mortgage, I put down 3.5% FHA, right? First time home buyer administration, right? FHA. That allows you to put 3.5% down of the total purchase price. So let's go flat number. If your house was $100,000, 3.5%, $3,500. That's your down payment. That has nothing to do with closing costs. which is usually like another point, and it has nothing to do with your attorney fees and your insurance. But altogether, you'll probably be like, if it was FHA on $100,000 home, you're probably like $7-8 to get in that house between closing costs, down payment. So if you times that by $300,000, then it's it's $10,500 to get in, 3.5%. Understand?
I understand.
But that most FHAs come with what's called PMI, private mortgage insurance.
Okay.
And private mortgage insurance is just another bill, basically risk of insurance, like, because you could be a risk, because they're taking on most of the cost of the loan. They're going to charge you private mortgage insurance. If you put down 20%, you won't get charged that. But let's not get it twisted. There are many banks that won't even charge you the PMI if you even go 5% conventional. If you go conventional loan, there's a great chance you won't have private mortgage insurance. Private mortgage insurance is usually 10% of your total fucking loan.
So if you have $100,000 home, it's $10,000.
Yeah, so
well, not $10,000 a year. So in this case, let's say of your total payment, let's say your payment's $2,000 a month. It's gonna be $200. Your PMI
on PMI
every month.
every month added.
So
Every month.
for the most,
and it'll get eliminated once you make 20% of the balance paid down.
Okay.
that's what I was gonna say.
Yeah, so you save $200, but a lot of PMIs before $500, $600. Let's say you get an $800,000 home, 10% of $800 and let's say it's $6,000 a month. 10% of $6,000, $600 a month. That's a Mercedes Benz. Every single month you're paying for. So
just to have that protection.
Correct. Well, it's a standard charge that they're going to charge. So you can either say, yo, fuck it, I'm going to go FHA and just pay the PMI. I'll pay the extra $600 because I'd rather keep, $50-$60 in my bank on a down payment. Or you can go conventional and save all that money. But a lot of people don't have the 20%. A lot of people don't have 10%. But I know a lot of banks that will do 5%, no PMI also. So my last deal was 10%, no PMI. I put down 10%. I paid $1.1 million for the home. I put down 10%, and I had no PMI. And I had an interest rate of 4.25, so my payment was like 62 something.
Fixed or the
no arm. No arm.
Fixed. I ain't going no damn
I'm
arm.
the last guy with a adjustable.
Nah.
That. So one more thing, and this is new because in the times that we are currently. We're going to see these 6% interest, 7% interest. Yes, a lot of those that are getting into the buying a home for the first time or second time are probably going to hold back. But you can still move forward. Get into it. As long as you understand that you're going to hold that interest for a couple of years. You always have the option of refi when the interest goes down.
Yeah. See, like if I had to pay an extra $800 on a home, because of the interest rate, I'm going to pay it the minute the market drops again with the interest rates. I'm going to refinance, get out of it. I'm not going to... Remember, you can't replace the home. Once the home is sold, that's it. You fucked. You got to go find another neighborhood, another safe place. You know what? I'll pay the $800, and then once it comes down, I'll refinance.
So for the listeners that, yeah, it's tough. It sucks. 7% interest, 8% interest is going to suck. I still recommend you go move forward with the purchase of your home. Just understand that you're gonna hold that high bill for a couple of years, and the moment that it drops, as long as you maintain a good credit score and a good payment history, you always refi and you get that savings, and the best part is you get that home that you want.
Well, let me ask you guys this: so what is the timing between the time that you purchased a home and the time that you can refinance a home?
You can refinance within 30 days, because I did that. I got a home, then I refinanced 30 days later. I just needed the loan to show up on the new mortgage company's end. The minute it showed on their first statement, I refinanced. I got out of it. I got out of a 425.
Because I know some people will probably get that they're not, fully aware, or it's the first time purchasing a home, probably won't be aware of what they can do. So I was curious.
You can, but it's just like the stock market. You have to wait for that dip. In his case, the time period where
I was buying at a good time.
He was buying at a good time where he purchased at a really good rate, right? And the interest was continuing to drop, so he was able to double down and
Yeah, but I was plotting also. I was also plotting. I'm plotting all the time. So I was plotting. It worked in my favor. Great. But, with the home, credit score is number one. To get the best interest rate as well as not get into an unfavorable mortgage program. You know what I'm saying? Number two is taxes. You got to file your fucking taxes, guys. All right, straight up. Do not think, because you can afford a home, that you're getting the home. If you didn't file your taxes, you're not getting the home. Okay? All right, yeah. So I'm actually done with your taxes. So in order to pay me, all right. Because I see that all the time. Yo, I want a home. Guess what? You file your taxes? No. All right, you're not getting your home. But then when you go ahead and tell them their bill, I can't afford. Well, you can't get a home. That's it. You know why? Because you thought you could have your cake and eat it too. When getting a home, there's no such thing as having your cake and eat it too. You want a $400,000 mortgage? Your tax returns need to show that it can support a $400,000 mortgage.
Check this out, and then we're wrapping up, right? I know at least 20 people right now that pay $4,000, $5,000, $6,000 rent, right? They can afford $1 million home easily.
I know a couple of people.
They can afford $1 million home, but they're nowhere near affording $1 million home. You know why? Because if they're paying $6,000 rent, they make $100,000 to $200,000 a year with no problem. Guess what? If they report $200,000, their bill is going to be $48,000. They get nervous. Nah. So you will never own a fucking home. Stop saying you want a home. You don't want a home. Okay? You don't want to file your taxes? You don't want a home. Go rent. Okay? And don't complain about rent. That's it.
And like I said, wrapping up, and my clients that know and trust me, follow my blueprint and my advice, they never regret this. When you have a tax bill of $50,000, $100,000, $200,000, that's where now we're playing. It's game time. Now it's hardball. It's game time because now you're getting that business loan. You're getting that personal loan. You're now playing with their money.
I see.
Right. So
listen,
don't be scared.
A bank needs to see what you make. And who you are or what you are on paper. That's it.
Just very simple. Very simple. You can make $300,000, say $200,000. You're avoiding to pay a high tax bill, so you're constantly making $200,000 a year, $200,000.
Nah, because you dope, because you want to be in that nice car, that nice apartment.
Great. Check this out.
Bum.
Let me pay taxes on that $200,000. 2 years, just for 2 years, and then I'll go. Hey John. Hey Ken. Show me how you get that business loan. And we show you. We walk you through the process, and now you get $100,000 funding, $200,000 funding.
We'll go to that actually the next episode. We'll get
wow, you guys are blowing my mind right now.
No, this is going to lead to the next episode with business loans, and I'm actually going to finish it today with you guys. So the last thing on the mortgage, you need the credit, you need the tax returns. All right? The last thing is you're going to need that down payment. Okay? Down payment could be 3.5%. It could be 5%. But you got to have that down payment. All right? Other than that, with mortgages itself, hey, you rent, it gets thrown away. You buy, guess what? It's an asset. Most of the time, it appreciates. It's going to keep going up. Your balance every time you make a payment goes down. But try to beat the bank. Pay a little more every month. You pay $500 more than what your mortgage is every month, and you'll probably shave a good 10 years off your mortgage.
And that $500 is going towards the principal, right?
Yeah, going towards the principal. 100%. 100% going towards the principal. Mortgage is very simple, like I said. But, you got to be in position to, want to get a home. And homes come with some debt, man. Remember, you're responsible for that boiler. You're responsible for that yard. You're responsible for that roof. So be very vigilant when you're actually getting your mortgage too. If you get an older home, understand there's a lot of risk. If you get a newer home, there are a lot of times they're covered under warranty. So you know what? Maybe paying $100,000 extra for the newer home may be worth it, or $200,000 for the newer home may be worth it, because if you buy an older home, you're gonna have to put $100,000 in. then you're gonna have to, basically be
Makes sense. Make a lot of
100%.
sense.
It's different things, but guys, thank you for
Tuning in with us.
Yeah.
The topic was mortgages, but we touched on so many other aspects of life. I think that what I'm learning, especially being here with you guys, is that finances, period, they all kind of tie into each other. You know what I mean? It's like a big web. That,
it's a massive. It's a massive system that does not work without the other unless it involves corruption. So you can't get the house without having that credit score there. But if
taxes you gotta have,
corruption fucks everything up. You pay somebody $100,000 and you get your house without filing taxes.
Shit.
You know what I'm saying?
Well, listen, you guys heard how to get it the right way here at True Pod. Thank you, Jonathan Hernandez. Thank you, Kenny George. We're out of here, guys. We're here at True Pod
Peace
in
out.
Garfield, New Jersey. Thank you for listening. Hope you picked up some of these gems.
Once again, John, what's your social?
Wait, on social what? Security number?
Your social, your
social.
your Facebook.
Oh, nah, I haven't been on Facebook in like 47 years.
All right, cool.
No. It's at truthful_taxes. At I don't like giving out my personal page, but at we are Truthful Taxes.
And True Pod.
True Pod, true, and then P_O_D. All right, True Pod, and then follow our. Actually, subscribe, like, comment on our YouTube page.
Absolutely.
Right?
Do not forget to comment if you have any questions.
Comment, man. You can curse me out, whatever. Say you don't agree, and I'm gonna say I agree, and then you say you're wrong, and I'm gonna say you're right, and then we're gonna go back and forth, and then I'm gonna say I love you.
And catch me on Kenny Taxes at Kenny Taxes.
Yep. Peace out, guys.
Peace out, guys. We're out of here.
Just don't provoke me, cause I don't need no cellmates. I'm in a 2-seat, doing drops like a mailman. This ain't no hoopty ass, she riding, she's a hell yeah. No, I won't lose sleep about no pussy, I'm like farewell. Yeah. I'm outside. I know how it feel to see your homie switch sides. I know how to put that Rolls Royce shit in drive. I know how to load a clip and shoot, we gotta ride. You ain't gotta lie to me, baby, no.